Hello everyone, this is Dr. K. Jagannayaki, Professor in MBA Department, Institute of Aeronautical Engineering, Hyderabad. Today's topic is cost analysis and cost concepts. After going through this particular topic, the learner will be able to understand the importance of cost analysis, able to identify the meaning of cost concepts and different types of cost. Coming to the cost analysis means the process of examining and evaluating the various costs associated with a particular project, a business operation, or a product. It involves the systematic breakdown and assessment of all costs incurred to understand the financial implications of a decision or an investment. Cost analysis is a crucial tool in business management, financial planning, and decision making. For example, when you are talking about the cost of the product, so let us take the price which is fixed by the company. It includes cost plus profit margin. So this cost includes the total cost includes both the direct and indirect cost. So direct cost is that which directly involves in the production process, and indirect cost it includes other than production functions. So together is known as the cost. So whenever the companies they are planning to make decisions related to various strategies or any kind of decision, that is first starts with the analysis of cost. Coming to the definition of cost analysis, it is a financial management process that involves the identification, classification, and evaluation of all expenses incurred by an organization. So, here, when you are going to take up any project or even it is a product, initially we have to evaluate, we have to identify how much expenditure incurs to produce a particular product or to carry out a project. How do we classify those costs and how to evaluate all the expenses that should be done with the help of cost analysis? It aims to determine the total cost of production, operation, or a specific activity. It is a systematic examination of direct and indirect costs associated with a particular business process or investment. It helps the organizations make informed decisions, set pricing strategies, and allocate resources efficiently. It refers to the comprehensive study of expenses, including fixed and variable costs, overheads, and other financial outlays, to assess their impact on profitability and to identify the areas for cost reduction and optimization. So, as we know in the organization, whatever resources available, the financial resources they are always limited in size. So, we need to utilize those limited resources up to optimum level. So that should be done with the help of cost analysis. It is the process of breaking down and studying all components of a cost structure, such as material cost, labor cost, overhead expenses, administrative expenses. So all these costs we need to classify and to determine the total cost of producing goods or delivering the service. So it is an essential tool for business to evaluate the financial feasibility of project, measure the cost effectiveness of products or services, and also analyze the impact of cost drivers on overall expenses. Then coming to cost concept, the cost which a firm incurs in the process of production of its goods and services is an important variable for decision making. So any type of decisions that depends on the cost of the product or the type of service you are dealing with, and if you want to develop any new product and you want to diversify any kind of decision that is related to the cost. The total cost together with the total revenue determines the profit level of a business concern. So, how can we derive profit? Profit is nothing but if the revenue is greater than the expenditure, total expenditure, then only we can able to generate profits. Otherwise, instead of generating the profit, we'll get the losses. So that can be derived with the help of cost concept. So in order to maximize the profits, a firm endeavors to increase its revenue and lower its cost. If the objective of any business firm is maximization of profits, so to gain more profits, the company try to lower their costs wherever possible, and they have to improve their revenue. As a result, they can see the profits in the long run. So, to this end, managers try to produce optimum levels of output, use the least cost combination of factors of production, increase the factor productivities, and improve organizational efficiency. So, cost play a very important role in managerial decisions. It involves a selection between alternative courses of action. So the decision making process, it involves selection of the best option from the available alternative courses of action. So whatever alternative courses of actions available, so we need to evaluate each and every course of action, and from that we have to select one among them as the best option. So it helps in specifying various alternatives in terms of their quantitative values. The kind of cost to be used in a particular situation, it depends upon the business decisions to be made. Cost enter into almost every business decision, and it is important to use the right analysis of cost. So as a result, to understand what these various concepts of cost are, how these can be defined and operationalized. So it requires the understanding of two things. First, we have to understand the cost that estimates produced by conventional financial accounting are not and appropriate for all managerial uses. And second one is that different business problems call for different kinds of cost. So if you can able to analyze these two things, then we can easily achieve our objective, that is maximization of profits with minimization of cost. The next one is types of cost. There are different categories of cost. The first one, future and past cost. So futurity is one of the important element of all the business decisions. Future costs are the estimates of time adjusted past or present cost and are reasonably expected to be incurred in some future period or periods. So in general, the cost estimation should be done based on the past experiences and the present status of the business. Based on that, we used to predict the future cost. So their cost incurrence is a forecast and their management is an estimate. So like our union budget, the government they used to estimate figures based on the past and the present position of the economy. And past costs are actual costs incurred in the past and they are always contained in the income statements. Their measurement is essentially a record keeping activity. So, whatever the cost associated with any type of business operation, immediately that has to be entered in the book of journal and the same to be posted in the ledger. And based on that, the companies they are going to prepare their final accounts to know the overall performance of their business. Then next category is incremental and sunk cost. So incremental cost defined as the change in overall cost that result from particular decisions being made. So incremental cost may include both fixed and variable cost. So in case of short-term duration, incremental cost will consist of variable cost, the cost of additional labor, additional raw materials, power, fuel, etc., which is the result of a new decision being taken by the firm. Since these costs can be avoided by not bringing about any change in the activity, Then incremental costs are also called avoidable cost or escapable cost. They are also called as differential cost. So when you are going to add an additional unit of labor, so it do not affect the overall cost of production. So that type of cost are known as incremental cost. The next type of cost is known as sunk cost. It is one which is not affected or altered by a change in the level or nature of business activity. It will remain the same whatever the level of activity. Whether the volume of production may be 5,000 units or 10,000, 15 or 20,000 units, it remains the constant. So the most important example of sunk cost is amortization of past expenses. For example, whenever you're going to talk about depreciation, it remains constant at all the levels of production. The next type of cost, out of pocket and book cost. So out of pocket costs are those that involve immediate payments to outsiders as opposed to book cost and that do not require current cash expenditure. For example, when we are talking about wages and salaries paid to the employees are out of pocket cost, while salary of the owner manager. If not paid, then it is said to be a book cost. The interest cost of owner's own fund and depreciation cost are the other examples of book cost. Book cost can be converted into out of pocket cost by selling the assets and leasing them back from the buyer. And next, replacement and historical cost. So, historical cost of an asset it states that the cost of plant, equipment, and materials at the price paid originally for them, while the replacement cost states that the cost that firm would have to incur if it wants to replace or acquire the same asset now. For example, if the price of bronze at the time of purchase, let us take in 1974 was 15 a kg, and if the present price is 18 rupees a kg, the original cost of 50 rupees is the historical cost, while 18 rupees is replacement cost. So replacement cost means the price that would have to be paid currently for acquiring the same plant. The next type is explicit cost and implicit cost. So explicit costs are those expenses which are actually paid by the firm, which are known as paid out cost, and these costs appear in the account records of the firm. On the other hand, implicit costs are theoretical costs in the sense that they go under recognized by the accounting system. So these costs may be defined as the earnings of those employed resources which belong to the owner himself. The next type, actual cost versus opportunity cost. Actual cost means the actual expenditure incurred for acquiring or producing a good or service. These costs are the costs that are generally recorded in the books of account. For example, actual wages paid, cost of materials purchased, interest rate paid, wages paid, etc. And direct or inseparable or traceable cost, and indirect or common or non-traceable cost. So there are two costs which can be directly attributed to the production of a unit of a given product. Such costs are known as direct cost, and they can be easily separated, ascertained, and imputed to a unit of output. So this is because these costs vary with the output units. However, there are other costs which cannot be separated and clearly attributed to individual units of production. So these costs are classified as indirect cost in the accounting process. Next, shutdown or abandonment cost. Shutdown costs are required to be incurred when the production operations are suspended and will not be necessary if the production operations continue. When any plant is to be permanently closed down, some costs are to be incurred for disposing of the fixed assets. Then these costs are called abandonment cost. The next category is private and social cost. So economic cost can be calculated at two levels. One is micro level, another one is macro level. So when we are talking about micro level economic cost, it relates to the functioning of a firm as a production unit, Whereas coming to macro level economic costs are the ones that are generated by the decisions of the firm but are paid by the society and not the firm. So private costs are those which are actually incurred or provided by an individual or a firm for its business activity. Then social cost is another type of cost, which is the it is one type of total cost to the society on account of production of a good. So the economic cost include both private and social cost. Then comes fixed and variable cost. So fixed costs are those which are independent of output. It means that they do not change with the changes in the output. These costs are fixed amount which must be incurred by a firm in the short run, whether the output is small or large. Irrespective of the output, whatever cost incurred that remains the same. So fixed costs are also known as overhead cost and include charges such as contractual rent, insurance fee, maintenance cost, property taxes, interest on capital invested, minimum administrative expenses such as manager's salary, watchman's wages, etc. So thus fixed costs are those which are incurred in hiring the fixed factors of production whose amount cannot be altered in the short run. Then variable costs on the other hand are those costs which are incurred on the employment of variable factors of production whose amount can be altered in the short run. Thus the total variable cost change with the changes in output in the short run. These costs includes payments such as wages of labor employed, the price of raw material, fuel and power used, the expenses incurred on transporting and the like. Variable costs are also known as prime cost. Total cost of a business firm is the sum of its total variable cost and total fixed cost. So it can be symbolically defined as TC is equal to TFC plus TVC, where TC means total cost, TFC stands for total fixed cost, and TVC denoted as total variable cost. Then short run and long run cost. Short run costs are those costs that can vary with the degree of utilization of plant and other fixed factors. In other words, these costs relate to the variation in output given plant capacity. Short run costs are those are of two types, fixed cost and variable cost. So in the short run, fixed cost remains unchanged, whereas variable cost fluctuate with the output. And long run cost, in contrast, are the costs that can vary with size of the plant and with other facilities normally regarded as fixed in the short run. So in the long run, there are no fixed inputs and therefore no fixed cost. That is the reason all costs are variable. Then short run average cost and output. The cost concept is more frequently used both by businessmen and economists in the form of cost per unit average cost rather than totals. So short run average fixed cost means it is the total fixed cost divided by the number of units of output produced. So AFC equal to TFC by Q, where Q represents the number of units of output produced. Thus, average fixed cost is the fixed cost per unit of output. Since total fixed cost is a constant quantity, average fixed cost will steadily fall as output increases. Therefore, average fixed cost curve slopes downward throughout its length. So, as the output increases, the total cost spreads over more and more units. Therefore, the average cost becomes less and less. Then average variable cost, which is denoted as ABC. So average variable cost is the total variable cost divided by the number of units of output produced. And it is denoted as ABC is equal to TVC by Q. So average variable cost is the variable cost per unit of output and ABC is the cost, the price of the input multiplied by the reciprocal of the average product of the input. Then what is average total cost ATC? So average total cost, what is simply average cost is the total cost divided by the number of units of output produced. Therefore, ATC is equal to TC by Q. Since the total cost is the sum of total variable cost and total fixed cost, the average total cost is also the sum of average variable cost and average fixed cost. So, average total cost is also known as unit cost since it is cost per unit of the output produced. To produce one unit of product, what will be the cost? That should be derived with the help of average total cost. Then comes short run marginal cost and output. Marginal cost is the addition to the total cost caused by producing one more unit of output. In other words, marginal cost is the addition to the total cost of producing n units instead of n minus 1 units. So that is the reason MC and marginal cost, for n units it is denoted as MCN is equal to TCN minus TCN minus 1. In symbols, the marginal cost is the rate of change in the total cost with respect to a unit change in output. So MC is equal to D of TC by DQ, where D is in the numerator and denominator indicates the change in TC and Q respectively. So it is worth pointing out that marginal cost is independent of the fixed cost. Since fixed costs do not change with the output, there are no marginal fixed cost when output increases in the short run. It is the only variable cost that vary with output in the short run. Therefore, marginal costs are due to the changes in variable cost. So MC is equal to percentage change or D of TBC by DQ. The properties of average cost, average fixed cost, average variable cost, and average total cost and marginal cost. So the properties of the average cost and marginal cost can briefly described as follows. AFC declines continuously, approaching both axes asymptotically, and ABC first declines, then reaches a minimum and rises thereafter. When ABC attains minimum, MC equals to ABC. So marginal cost is equal to average variable cost. Then as AFC approaches asymptotically the horizontal axis and ABC approaches ATC asymptotically. And ATC first declines and reaches a minimum and rises thereafter, where ATC attains its minimum, where MC equals to ATC. MC first declines, reaches a minimum, and rises thereafter. MC equals ABC and ATC when these curves attain their minimum values. Furthermore, MC lies below both ABC and ATC when they are declining, and it lies above them when they are rising. Thank you.
Like, share and subscribe. Hit the bell icon for more updates.